Shout out to everybody here for the Fed meeting. We're going to go over the chart, show you what just happened. I got some trades that are actually cooking right now and still in the green. I'm up 474 on a trade. I'm going to show you how I did it. We're going to break it down. I don't know how I circumvented the market like I did today, but man, I traded the Fed day with the gains. And what I did is I put deep stop losses below some key areas. You know that double bottom? I figured they wouldn't rate it. So I had, you know what I mean? Look, I'm up $412 in this trade right here. Oh, let me show you the screen. Might be a good idea. I'm up $412 in this trade. And these other two trades, I'm up, they were down though, right? But one's up 30, one's up 20. Not a big deal, but I'm up about like what? 60 bucks right now. Not a big deal, but hey, it's Fed day. And I didn't get clobbered like most of the world. Is this sustainable? This price action was absolutely insanity. We're going to break down what happened in the last few minutes and how the strategy is still strong. So they flagged the 5-minute time frame. And you could say, okay, we're going to bounce to the upside. Possibility, right? Flagged it out above the 200. That's my system. They got the pump. They dumped it back to the 200 to rip it back up again. And who knows, man, what they're going to do today. I'd be very, very careful. See, I got my stops very deep, way below the 200 moving average. This is just a tactic I use. I make a bigger trade over the smaller trade. Very interesting idea and concept, all right? And also, when it comes to most trades, I take my profits, man, because the volatility is absurd today. It's absolutely absurd. So, yeah. That's kind of So let me actually send this link out to the group. They don't know. Not everybody knows that Sammy's live or exactly when I'm going to be live. Let's go over to the studio and send that link out to the Discord. Shout out to everyone here on the live. Thank you for being amazing, kicking it with the lifer, and being awesome. Let me double check that I am live and see that we are live, but we should be. I believe I put in the right key, and we're ready to rock. Oh, the wrong key? No, yes, okay. It was delayed for a second. I thought I was beat. I was like, no. And if you want to trade who we trade, you can hit the pin comment to Weeks, BTCC, or MEXC to jump on in. Appreciate each and every one of you for being amazing and being awesome as we get ready for Jerome Powell. He was going to speak in about 12 minutes. Hopefully it doesn't matter. Hopefully it's his farewell speech, man. He puts, he'd be mailing these in at this point, right? What does he care? So, and we're live for the Fed. So the Fed rate came in at 3.75. People say they weren't going to cut rates. I told you that was shenanigans. Don't listen to people that say stuff like that. Like, it's been spot on ever since. Okay. Tomorrow we have unemployment at 8:30. Get ready for that. But look at this, 3.75. It was as forecast on that CME watch tool. You see 350, 89%. Round 2, fight, you're funny. We back in time. Yeah. Sam, are we selling or buying here? Oh, hey, great stream earlier today. The stream earlier today was unbelievable. One of the best streams we ever had. I told you I was going to come suited differently. So they flipped it to 91. The rate came in already. It's been done. And now you move on to January, right? And now there's a 73% chance they cut the rates again. So that's bullish. Right off the bat, you start speculating on the next rate cut. That's not till the 28th. So we have ourselves about a month and a half off now before we go back in. Let me also get the tube up and running over here. 1 second, I gotta grab this, put this over. Oh, and what I want to do now is search the Federal Reserve. They have their own channel, you know what I mean? They have their YouTube channel. And we're waiting for Jerome Powell. I got it up and running. When the time is right, I got to turn off their sound. But when the time is right, what's funny is I turn the sound off here, but then you can't see it. So I'll turn the sound off here. Interesting. That's something I never thought of. So Jerome Powell comes live at 2:30. We're going to listen to what he says as we watch the market. And if you've watched this channel before, what we're going to do is we have Bookmap up on the left. I'm going to be, if I see a live trade, I'm going to have my live trading software open on another window, preferably on the 1 or the 5 minute. If I ever trade, that's the time frame. And then what I also do is I take Bitcoin here, I delete all the work we've done. We go to like the 1 minute or the 5, I shrink this window down, and I do live, basically TA commentary while he's talking like I do live TA. Sometimes I don't say anything. I'm just drawing while he's talking because I can't talk over him. You see? But just stick with me like you're going to know what I'm saying. So like right now, it's kind of looking like a flag that could break up. You know, they broke it up. They broke it down. Kind of flattened this top a little bit. And so I'm looking for a move to the upside for Bitcoin because it looks like an inverted head and shoulder. Kind of looks like a diamond. Looking for that to go somewhere up, I don't know, 94, 95,000 dollar BTC. Okay. Yeah, I mean, that looks like we're going to cook to 94.3. I'm still long. So we'll see what happens. But, you know, they're cutting rates. More money's coming in. And people are freaking out. We'll see what happens. Sammy for Florida mayor, I know, right? The mayor of Florida. The governor. I'm going to govern him. Hello. Hello, governor. Hello, governor. Shout out to my lovers of life. Shout out to everybody out there getting ready for Powell. Powell. FOMC press conference. It's coming faster than we realize. Bitcoin 92,800. Nice little pump for BTC. So I got Bookmap ready. I got the chats ready. And I know I'm ready. We got a big red up there at about 94,250. Price action has played games all day long, but we are up. We are up, right? From 91.8 back to 92.8. So we did get a bit of a pump. Sammy's in the green. We're going to see what happens. And only time will tell. When Jerome Powell comes on, we're going to turn down the music. Turn up Jerome. I'm going to slide a little smaller into the bottom of the screen, and we're going to have ourselves a blast listening to him just mail in his last conference, really, right? I think this is his last. Maybe not. Second to last, third to last conference. He's going to mail it in. That's what he does. All right. Sam, I'm saving up my money to join you for a year. Just get it done, baby. The Black Friday just passed, though, man. It was just 666 if you had done the whole, like, or I don't know if it was 666. Yeah, it was 777. But, yeah. Typically, diamonds go the same direction they came in. So if it came in from the top, it'll go through the bottom. If it comes in from the bottom, it's supposed to go... No, that's wrong. Look what you just said. You just contradicted yourself. You said typically diamonds go in the same direction they came in at. So if it came in from the top, it'll go out through the top. If it came in from the bottom, it will go down out the bottom. Came in the way they came in at. You just said they go out the opposite. See? You just contradicted yourself. Typically diamonds go the same direction they came in at. So if it came in from the top, it would go out through the top. Understand? Yeah. Yeah, you contradicted yourself in that statement. I don't know why. But it's okay. Things happen. I've probably done the same thing myself. I'm not putting you down. I just want to clarify. If anyone wants help with the diamond, let me draw a diamond for you. Show you what I see. A little loud for the music. Sorry about that. But so price would come up. It kind of goes sideways. Then there's this like big pump, big dump. And then it comes up and kind of goes sideways again. That would be a diamond pattern. I like the path, right? And you would be like, oh, I see a bit of a diamond. And you'd be like, oh, it's likely to come out the bottom because it came in the bottom. Diamonds are not, 60, 70% chance, basically they reverse the price back to where they came in. If it was on the bottom and the diamond pattern came in from the bottom like so, and it came in like this, you would expect it to break back to the upside. Okay? Not in and out and in and out. In and back out. In and back out. Reversal patterns, not continuation pattern. A diamond is generally a reversal pattern, which means price comes in, reverses back the way it came out. Okay? Exactly. Say, can I buy in now? Of course you could buy in now. Send an email to cryptolifers@gmail. If you really want to get in for the year, yeah, we'll find a way to hook you up. All right? We'll find a way to hook you up. At least 777. So, just send us an email. Tell us your desire. Let's find a way to meet you in the middle there. CryptoLifers@gmail. Tell my wife what's going on. She's nicer than me. So that's all I'm going to say there. Bitcoin still somewhat sideways as we get ready. 4 more minutes to Powell pops on in and explodes the mic. Does the mic drop? Then we're going to see, Kobe Smith, right? All those awesome people that we remember so much. All those journalists, right? McCabe, what is that guy? There's so many of them, man. We know them all by heart. We know them all. Like, I remember all their names and faces by now, right? We've done this we've done FOMC, I don't know, 12 times a year. It seems more than that, but, or 10 times a year. We've done 4 years. So we've done, what, 30? About 30 FOMCs, maybe 40 in the last few years. Seems less than you would think, but it's been amazing. So we're watching Bitcoin right here inside of this triangle. Could easily double top roll over, could bounce. If it loses the 200 on the 1 minute, we're going to dump. If it hangs out and gets above it, chances for a move. Fed panics and often incentivize to borrow money instead of paying. Yeah. Heat map breaking down, 92,004. I don't know why we're looking at super. I think that was the last super chat that just got left on screen, on chain. And then get ready for FOMC. Here it is. We have to unmute at the right time. I can't wait. Let me see what's happening in the chat. Shout out to everybody in chat. May God bless you all for being here. Good afternoon. Made $203 at 10 seconds. Fed panics. Do I buy USD now? Tripow. I'm just trying to become invisible, so liars stay away. It's working. I like that. I miss when Bitcoin was bullish. So do I. Sam, please don't ever run for office. We need you on stream every day. We love you, brother. I know, right? It's like Bongino. Now he's gone. He was way better off on YouTube, right? I mean, I'm just saying. Now you never hear from him. He's like in the dark. Trading was 62. What must I do, my law? I don't know, man. That's tight. Trading was 62. What must I do, my lot size? I don't know. I don't know what the actual question is. Yeah. We all already know that the Fed cut the rate, man. All right? You silly rabbit. We just watch what he says now and how the market responds. We might have a double top dump on our face here. It just, price action's iffy. I would literally just watch what he says, wait it out. A lot of times I don't even trade tonight. I let the market kind of find its way. Thursday, Friday, it just, FOMC always throws a hanger in it all, right? You are in top chat. Shout out to GF Burke. What do you think about Russell 2000 breaking the all-time high? Everyone televising this, but I chose you the best, Sammy. Thank you. I appreciate that, man. Hey, we do it the best. We give you more information. Like, no one's going to be live streaming the 1 minute chart while they're looking at Bookmap and Tripod. Like, you're just not going to get it anywhere else. You're going to get some good stuff. And I have some friends that do it today. I don't want to put anyone down. But I just believe my commentary is the best. You got to think you're the best if you're doing something. Why do it if you're not the best? If you don't think you're the best? If I was a quarterback, I would think I was the best, maybe. Or at least one of the best. Not better than everybody else, but at least I would put in the work to think I deserve the most. Let's go, baby. Let's go. 229, about to hit 230. He's always a couple minutes late, too. They might open it up, and then we have to watch and shuffle paper. Sammy, twice a day. Damn, we lucky, my dude. Shout out to Vetty Goat in the house. No more night shift after this trade. I bet X50. Oh, my gosh. Anybody know what the name of this track playing in the background is? Yeah, it's called City Skylines by Sunwave. City Skylines by Sunwave, if you ever want to play that puppy. Let's get it in. Let's get the mute. Let's get it up. Let's see what they're saying here for Powell. We're going to open this up as well. As you can see, we're going to have Bitcoin on this side. I'm bullish. I got longs. You know, he's going to talk about easing regulatory space and, oh my gosh, here he is. Oh my gosh. I'm just waiting all my life for this moment.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed.
He starts with that.
As much since our meeting in October. Conditions in the labor market appear to be gradually cooling.
Thank you for the super chat.
Inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower
it doesn't have to go off the wick, just the
interest
candles.
rate by a 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time.
That's going to get the
thus
algorithm to
supporting
go.
effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter.
Dude loves talking about that,
these
huh?
effects should be mostly
He harped on it
offset
3
by
times
higher
already.
growth next quarter.
You can already hear his
reflecting
bipartisan
the
nature,
reopening.
right? It's like he's always
In
digging.
our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability
digging on Trump every
and
time.
firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months.
92.9, baby, let's go.
In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter.
That's great. I love
Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run.
Let's go to 94.9.
Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people.
Mailing it in.
At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.5 to 3.75%.
Because we don't know what
In the near term,
we're doing.
risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals.
On the 1-minute chart for you now.
A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived.
Strong move to 93K.
Shift in the
93.1.
Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem.
Bookmap wants 95.
But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides.
They got a lot of noise on their mic, not me.
Accordingly, we judged it appropriate at this meeting to lower our policy rate by a 1/4 percentage point. With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well-positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary
93, baby, 93. Let's stay above 93 and get this pump
on. In this regime, standing repurchase agreement or repo operations are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible.
Boom, the 93.5. Let's go.
To conclude, the Fed has been assigned two goals for monetary policy.
I want to see 94.8 by the end of this. 96,000.
We remain committed
to
supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities,
93.1, there it is,
across the country.
I'm telling you, it looks like the pump
is in service to our public mission.
We're $538 now in the Fed trade.
Our maximum employment
$533 in the trade.
And I look forward to your questions.
Let's go. Wow, he mailed that one in. So when you said this, did you mean that?
Thank you. Howard Schneider with Reuters.
Schneider.
First, turning to the statement.
This guy's cool.
Just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs?
That could be bearish. We don't want to hear that.
Don't ask bearish questions. Baseline outlook.
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks.
I knew that was bearish. That was going to bring the price down.
We had a pump, man. We'll carefully evaluate the incoming data.
That was a bad question.
And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis basis points since last September. The Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned.
We don't want to hear
wait
neutral
see how
value.
The economy evolves.
No, that's not.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it's partly that consumer.
See, what I'm learning is it's just really bots. Bots are listening to keywords. The keyword's going to flip the bots. We need keywords that sound more bullish. When he asked that question, it wasn't a good question because we heard neutral. We don't want to hear the word neutral. That's why we started to dump. This is all bot keyword associations. This is going on. This is AI trading at its best.
Expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive.
You lose this 200, you're going to dump again. Resistance.
The consumer continues to spend.
Damn, it looks so nice.
It looks like
we just needed him to say a few more things. Repo Fed, blah, blah, blah. That guy asked such a whack question right now at the beginning of the keyword site.
Thank you, Mr. Chairman, for taking our questions here.
This guy goes hard every time.
You had previously described rate cuts in terms of a risk
Steve
management
Liesman.
framework.
Imagine if your last name said you lie. I'm called Liesman. Liesman, but Liesman.
Is the risk management phase of rate cuts over here? And have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that.
1 minute has to bounce off this 200 here.
We're going to factor into our
zooming
thinking.
In for you.
But yes, we have. If you go back, we held our policy rate at 5.4% for more than a year because inflation was very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year, and then we resumed cuts in September. And we
go. Resume cuts is a key. Is a good word.
Points. And as I mentioned,
it's a good word. That should create a green pump. Resume cuts. I like that.
Where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity.
Nice bounce off the 200 so far.
Some of that may be AI.
Beginning of a good point.
I think productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Colby Smooth.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the two official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what
I like that higher bar for cuts. That's a great keyword, man. She must have a long open right now.
Support a January reduction.
Like she just used such a good long keyword.
Let me just say as I mentioned, and as I've mentioned here
Keep
before,
talking Kobe Smith. I like the way, I like what you're saying.
Our two goals are a bit in tension, right? So, interestingly,
we pumped on that.
Everyone
right?
around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the two parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where
inflation is too high is a bullish keyword for Bitcoin.
It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're going to look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. You talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I could make that case. It's a close call. We have to make decisions. And we always hope that the data will give us a clear read, but in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment.
Yay,
and to the
upside! I want to hear that.
Inflation.
Upside,
so what do you do?
pump.
You've got one tool. You
say
can't
cup
do
and
two things
handle
at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick, Powell. He's going to go Powell. Watch, I love this guy. So funny.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did
Nick.
two discrete sequences.
Got to bring up that gap a little bit, Nick, though.
Quarter-point
Gotta
cuts,
clean that
one
gap
in
up.
1995-96 and one in 1998.
Clean that gap up by pushing it up and then bringing the shirt down.
The next move in rates was up,
clean.
not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
Oh.
So I don't think that.
Good question.
A rate hike is anybody's base case at this point.
I don't love right
and
now.
I'm not hearing
kind
that.
Of a shoulder,
what you see is
shoulder.
some people feel
Gotta hold this 200 MA.
And that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
So much static today.
Claire Jones, Financial Times. A lot of people
nice
interpreted
pump.
your comments
Let's go.
at the
93K
October
again
that,
off the bottom
when
of the
there's a
channel.
bloody situation, we slowed
did not
down
lose the 200
to
moving
mean
average.
That, there wouldn't be a cut now. There'd be a cut in January instead. So
can't believe I'm trading FOMC
why
again.
Why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said
they were moving.
That there was no certainty of moving, and that was
because I wanted to buy the S&P on the low.
It's possible you could think about it that way, but I was careful to say other people could look at it differently.
I gotta buy the lows first
today. I
can't
would say
pump this market before I get in.
First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
And just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets?
I wouldn't say concerned. So what really happened is this. balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in reserves, in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant, as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20-25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Sure. Right.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times. But this is such a unique situation.
Thank you so much. Appreciate that.
It's not the 1970s.
Underground crypto.
But we do have tension between our two goals. And so that's just unique.
We're getting tight inside this flag. A big move is coming, folks.
A long ways. We haven't had that.
We're not only just watching here. We're live trading. We got money on the board here.
When that's the case, then we try to take a balanced approach to the two things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to. And I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Nothing.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that,
like when he brings it up, he's like, well, because he mentioned that. So he's like, well, how long? So he's not going to have an answer for that.
It takes, there's the announcement
That's a good question.
of a tariff, and then there's, they start to take effect, and then it takes some months goods may have to be shipped from other parts of the,
Oh, wow, what a great way of getting out of that. He's smart.
Quite a while for an individual.
Look at that. He finds a scapegoat.
But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant there. And the president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
I don't mention that. I don't count on that. Look at his face. He goes, and he stares at him like, I'll have you dismantled.
Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got to, when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation.
Thank you so much for the super chat. We appreciate you.
That's one.
God bless you. Very nice of you. That'll come back to you tenfold.
Break-evens. And they're at very comfortable levels. They're at
underground crypto, applied dogs,
once you get out past the very short term now. Break-evens are at
still tight inside the 1 minute ascending triangle above the 221. That is the model. We should get a pump
that suggests
to 94.6. It's taking its time.
Like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So
please,
we hear loud and clear how people
Thank you for the super chat. Shezmoop.
Really costs.
Come on, we love you, man.
It's really high costs.
Shezmoop, we love you.
A lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up.
Thank you again.
Where people are getting jobs.
Sam, Dennis, for having this live chat. We appreciate all your efforts. God bless you. Thank you, Dennis Fetters.
We need to have some years.
Always being super awesome and attentive. God bless you, Dennis.
It's positive,
very nice,
significantly positive. So nominal wages are higher than inflation for people to start feeling good about the affordability issue. And so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria.
Thank you for the second stream.
Victoria,
God bless you. Very nice of you people.
Just to follow
this
up
is amazing.
on that, I mean, this is now the third time that you've cut this year, and inflation is around 3%. So is
You're not
the
making
message
any
that
sense.
you're sort of trying to send with that, that you're okay
It's
with
not
where
logical.
inflation is for now, as long as people understand that at some point you still want to get back to 2%, because inflation is relatively
She's
stable where it
funny.
is?
I love you.
everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But
you made people lazy after COVID, man. It was never the same.
Significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really
Thank you again. You people are too kind.
The story with inflation.
Made money off the model, giving back. God bless you.
We're well aware that
You're
this
a good man.
A story at this point.
You're a good man, Vidigo.
If you get away from tariffs, inflation is in the low 2s.
People are too kind.
So it's really tariffs that's causing the most of the
inflation. I'm going to stand up desk, work on my butt off since 7 a.m., baby.
Those as likely,
and I'll work all night.
In the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
Sounded right.
Thanks so much, Elizabeth
Sounded
Schulze with
good.
ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, that's
Let's go, baby. 93, 150.
Generally understand that. So, and we think it's about 60,000 a month. So 40,000 jobs could be
75 on the trade. They had me down $90.
10 or 20 in either direction. But in any case,
let's go. Trying to make myself a couple grand here. Hurry up, Jerome.
That's demand.
Up 611 on the
supply has also come down quite sharply. So
here's the pump. Here is the pump.
Had a world where there's just no growth in workers, and you really don't need a lot of jobs to have full employment.
Up 750, about to take my gains.
But I think
that's all I'm looking for. I want him to be greedy here.
Negative. I just think we need to watch that situation very carefully.
I'm out on Jerome Powell. Oh, you're going to keep going?
Pushing down on job creation with our policy.
When we're talking about
supply, God, 844. Let's get the 1,000.
Employers like Amazon cite AI in
we don't
job
even
cuts.
care.
How much right now are you factoring in
pump
AI
it, pump
into
it, pump it up. We gotta pump it up.
So it's probably part of the story.
Pump it up.
It's not a big part of the story
pump it up.
We don't know whether it will be. But
for
example, if you look at,
I'm going to take 850.
You can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite
863.
AI. That's all clearly happening. At the same time,
keep going.
People are
850,
not filing
862.
for unemployment insurance. And since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect
we gotta pump it up.
The continuing claims
pump
to
it
go
up.
up, and you expect
We gotta pump it up.
Really haven't
We
much.
don't pump it.
So
900 on the train. Let's go, Jerome, making me money.
The question is, what are
the
we gonna
pump
see
is
here?
real,
We
folks. The
don't know,
pump is
but
real. We called it. It was the model. Sammy Davis. I'm taking my money. I'm done. I'm happy. I'm a happy man. Confirmed. Gaines, baby, Gaines. They called him Sammy Gaines.
For a couple hundred years is when you get through
Sorry,
all
I get
that,
a little
you have higher
excited when I win.
productivity and you have
Let's
you
get
have
back to
new
Jerome
jobs,
Powell.
and there are enough jobs for people. This may be different.
Yes.
You know, every time we have a wave of technology, we think, oh,
Eat that loss from earlier
put a lot of
today.
people out of work. What are they going to do?
Take
In the
that.
past, there's always been more work.
That's all I was looking for, a little bit of a pump. I'm not greedy.
What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Thank you, Chair. And Curran, Bloomberg News.
Oh, it's going. It's continuing to rip now.
The policy committee. Why is there such a division of views between
the policy what?
On the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
You know, it's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and
still got weeks trades cooking.
And they're
to
people
add to the trade. Let these things
on both
run.
sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up,
nice
given
candle.
your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing in terms of growth and inflation? Thank you.
93,750. Let's
go.
go.
It would depend.
Let's go.
It would depend on a whole
He
bunch of
said
things
Stark.
we don't know. So,
Pump it.
can't
That was
really
a
help you
key
there.
word, Tony Stark.
Christine. Thank you.
Stark Industries.
Thank you, Chair Powell.
Mega
Christine
Man.
Romans, NBC News. I wanted to ask
Iron
you
Man
about
Pump.
how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling
trades
with
still
the
cooking. We
accumulation
still
of
got
5
trades
years
open
now
here.
of rising prices. It's price levels.
You gotta
not really
pay the
inflation
trader.
rate holding some of these families back. How sustainable is this so-called K-shaped economy?
It just hit the first target at
and what are the Fed's
93.8.
thoughts on whether that's a
Second
risk
target
going forward?
94.6. Can we get there?
So we do.
Sorry for
through our
talking
vast
over,
network of
but we're making
contacts
gains.
and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and
Here comes 94K. We've got rejected 5 times. Can we break through 94 to 96,000?
End of the income and wealth.
Get these pumps.
So, as how sustainable it is, I don't know. Most of the consumption does happen by.
What a call in the channel, huh? What a long call, baby.
I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. What we saw, for example, what we saw at the end of
It was the night
very,
before
very long,
Bitmas.
expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and
We
8
are
months or
ripping
something
right
like
now.
that. The longest one in recorded history. In the last 2 years,
crossed it all the way
most
to
of
the next-
the largest part
the
of the
next target,
wage gains
94.6.
were going to people in the bottom quartile,
pump is
the bottom
real.
part of the lower.
Told you
low moderate
93,
income. So,
4K.
having a strong labor market
96,000
for a
next.
long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen,
Master
is there a
friend
chance
of the
we're going to
house.
see more affordability in the housing market?
94,000, here we go.
Enjoy that part of wealth creation. I mean, the average age or median age of a first-time home buyer is now 40
The
years
model
old. That's
plays
the
out
highest
yet again
record.
on FOMC.
Yeah, so the housing
Nobody
market
better, baby.
faces some really significant challenges, and I don't know that a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low.
Look at the size of that candle on the 94, 188 pumping to the upside now.
And caught the really low, so it's maybe expensive.
Look,
for them to move.
no stop loss got hit.
And we're a ways away from that changing.
Trade the
Also,
flag,
we're
stop
just-
loss
we
below the
haven't built
200.
enough housing in the country for a long
Use the
time.
21.
And so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address, a secular housing shortage, a structural housing shortage.
That's good for real estate.
Chris.
You own real estate, you hear housing shortage, that's money right
Chris
there,
Rugaber,
That means
Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen
move above
now?
94 with the pump going to 94.6, folks.
The risk is either that
all the way back to the green monster. It's going, gone, baby, gone.
Because
home run, Babe Ruth.
Who are now holding back from passing through the tariffs will just keep doing that. So you'll see, you see that.
That's a nice move. We've been trying to get above 94,000 for 2 weeks.
It's just that the labor market gets tight or the economy gets tight, and you see
Weeks doing damage. Shout out to anyone trading on weeks with the lifer.
I don't see that as
gains, baby,
likely,
gains, 93%, 83%. You don't have to miss. I use $300 to make $300.
Across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times
back above the 200 in the 4 hour.
Do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity.
What a call on the show, man!
Saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Matty Lips. Sorry.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong.
Thank you so much for subscribing. Please subscribe to the channel, everybody. We need as many subscribers as possible.
To get to that place. They have been all along.
Working our butt off every day.
That's what I'm. And it's I don't have time to think
about.
That's
why I sold that puppy. Came right back down.
I hope many years ahead to worry about that, but there's enough to do.
Relatedly, Have you
This question doesn't
given
pump the
any more
market.
thought, and can you
Ask a
tell
question
us
that
any
pumps
more
the
about
market.
Your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't.
That's a question and a half. I don't want to hear that. That's bearish. I don't want to hear him on the board. I want him gone, retired, home. Going for walks in the park, man.
With Bankrate, even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates or yields, to be more precise, have peaked, while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all of the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave, sort of every large economy in the world, sort of every large open economy,
getting a bounce off that support there now,
in the world
retesting.
had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth. We had better labor market.
That oversold Stokes.
And this is really due to the American economy. We have an extraordinary economy, and people are innovative. They work hard, and so we're all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
That's it, dude. He's out. Wow, what an amazing time it is to be alive. I'm going to leave you with my last analysis. Kind of took a dump the second he left stage. Good thing I took my money and moved on that bigger trade. Shout out to everyone here on the live. Thank you for jumping on in. Appreciate you all for being with us during this Fed FOMC. One of the best we've ever had. I mean, that was awesome. When we went on their stream, they may have showed you, did they make gains during the stream? Did they show you how to trade live during the stream? I want to know. Look, now it could be a shoulder, head, shoulder. A lot of back and forth price action. Let's take a look at kind of what just occurred and where we sit and where we stand. First thing that we talked about here. Oh, actually, that's good music. I like it, but hold on. Yeah, it's over. Yeah. Let's take that out. There we go. Follow me at The Real Crypto Lifer on Instagram. I'm blowing up all the time. Awesome videos. We're putting in a lot of effort and work. See what we're doing. All right. We're having fun playing with objects, driving the Lambo. Just check it out. You'll absolutely love it. See what's happening here on the show. Okay. We love you. We miss you. Check it out. Have some fun. All right. Watch me, The Real Crypto Lifer. Just see more behind the scenes of my life. Get a little bit of what's happening. Stay connected. Become my buddy. Say, hey, follow me. Become my friend. So we're watching this ascending triangle for Bitcoin. Kind of like it hits the top now and comes back down. This $94,000 area, every time we've hit it, there's been a whale or someone that just takes so much liquidity off the table that we can't sustain. I'd like us to get back above it and hold it. Looks like we kind of hit it yet again, and now we might come back down. I just want to see chop. It looks like we stay in chop now, possibly for, till Saturday or Sunday, maybe even to Monday. So I would love to see chop and then a breakout. But I'm looking at this, and again, this is 50-50. It either comes back down to where it began here. We get the nice breakout to the upside. The key is the 3-day staying above the 200 moving average. Okay? Long as that continues to hang, as long as that continues to be a thing, we're okay. We are okay. However, I do still see a bit of a bear flag there. So we're still in the middle. Not much has changed. But again, you can still make $1,000, $2,000, $3,000 a day, like I just did. Just trade in what the market gives us. We don't have to get everything right. We just have to get a couple of the moves right that day. And we just got one of them today with the 1 minute. What did we do today? Well, I teach my students, and I go over this all the time. I wait for consolidation. I wait for the 21 to touch price action above the 200, and I like to nestle in with a stop below the 200. If I get a nice pump, the length of the previous pole, which is what we should get, that's what I'm looking for. 70% of that move and I'm out. That's what I do over and over again. I've done this on the 1 minute. I think I even almost did it earlier today. One of my calls actually played out already on the stream earlier today. So 2 of my calls played out. 1 I did get bagged on. You can see I obviously paid for my loss and more with my H60 win there. Sign up to mexc.com. Mexc is the best place to trade. You'll love it. Have a blast. Weeks as well. Weeks is amazing. And BTCC. I got trades open on BTC still. Tesla trades. We've got it locked in. And a gold trade. This seems to be kind of retesting a little bit here. I'm zooming out and looking at the bigger pictures. You know, zoom out to the 30-minute, the 1 hour. Don't get too caught up. I hit the small time frames when the time is right, but we move on from there, right? We took this huge pump yesterday. Remember, I made about 5,600 or 4,800. It's just been amazing, man. I've been showing you my skills using the 200 and how I'm able to manage the market even when it's choppy. Hey, that's $6,000 in a couple days, right? So everyone, I love you. I appreciate you. Let me reset myself so I'm back where I need to be for the show tomorrow, and we're just kind of all hunky-dory. But thank you so much for jumping on in, being amazing. Let's get the music back up and running in the background. Why not, right? Just do what we do. But you people are awesome. I love you. If you made gains with me just now, awesome. Give me a break. I need some time. Rest my eyes. Turn the lights off. I'll be back in the trading group very, very shortly, though. I'll be there all night and all day until tomorrow. I love you guys. I don't stop, won't stop. I just need to rest my eyes for a little bit. I think I've done enough for the group for a while. I'll be back, though. Everyone, thank you so much again. There's no words that I could fully describe my appreciation for each and every one of you. I love you all. I appreciate you, and I'll be back in the group throughout the day. Shout out to all my lifers in the Discord, everyone that supports me, everyone that leaves a comment, all the awesome. I mean, today, I really want to say thank you again, too, to the awesome people that left a super chat today during. They didn't ask for anything. You guys were just nice to me. Thank you for becoming a member today. Sam, I'm having problems with the Discord. I've sent an email. I've paid for the yearly, but I have no access. God bless. They'll take care of you. Usually people have 2 different Discords, and they forgot, and they're linking the wrong one. We'll get you situated, though. All right. Your model played out. God bless you. It did. Made money off the model. Giving back. Thank you. Thank you for the second stream. Dennis here. Thank you for the live chat. Appreciate all your efforts. Thank you. Thank you for the live. Smash the like button. Look at all the appreciation here. Make sure I heart every one of those. Like every one of them. And say thank you back to everybody. Shout out to Plag Dogs, Underground Crypto, BK Polar, Shez Mupta, Haman, Fetters Built Co., El Toro Crypto, Vetigoat, and Moonshine 5460. God bless everybody here on the live. Thank you for jumping on in yet again. I'll see you in the next live stream. Stay blessed, stay amazing. Thank you for everything. The secret to success is just keep it moving, baby.
Don't be lonely.
Just like we're